All right, welcome everyone. Today we're going to be talking about risk management for crypto trading. And I'm going to try to keep this session to an hour, but I'm not sure if that's going to be really possible, so we might go over a little bit. One of the things to keep in mind as we go through this is this shouldn't be taken as financial advice, but this is just the summary of my experiences as a trader in this space for about 6 years, and what has worked and what has not worked, and why I really feel that as far as edge goes, it doesn't really matter what your edge is or what your trading strategy is. As long as you have good risk management, you can be profitable. Okay, so let's just jump right into it. I have a map that will help me keep me on track for this, but we're going to go through this map fairly quickly because a lot of it's just background information. It's important to know surrounding, risk management and the things we're talking about, but I want to really spend the bulk of the time in this on demos of how to calculate position size, because that's really what's driving a lot of this. So to start with an overview, we talk about what is risk management. So in this context, we're referring to the processes and strategies that we use to minimize the potential for loss and maximize the probability of profit. So to do this, we need to identify and evaluate, all the potential risks and implement strategies to mitigate those, or at least to, minimize, if not eliminate them as we go. And there's different areas that we need to be concerned with here. Mostly we're going to be concerned with volatility in this, but I just wanted to list out and briefly talk about other areas that you should factor into your risk management process. First one is cybersecurity. So that just involves, keeping the hackers away from your stuff, using 2FA on exchanges, protecting your API keys, using cold storage and hardware wallets, things such as that. Now, technology kind of goes along with that, but it extends it to the actual tools that you use to enable you to do your trading. So here, we want to make sure that the exchange that we choose is reliable and that our connection to it, your ISP and your internet connection and things like that are reliable, so that you don't run into a risk of loss because of failure of that technology. When things get really volatile, are you able to get trades in and out of the exchange, things like that. Okay, counterparty risk is anytime you give your money to someone else to manage for you, like an exchange, you are taking a risk that they will give it back to you when the time comes. So counterparty risk, just think of FTX and all the people that lost money there with that counterparty. And there are many others too. With liquidity risk, what we're specifically talking about here is, in most contexts, is slippage. So a lot of us don't have to worry about this because we're very, small fish in big ponds when we're using exchanges such as Binance and Bybit and Coinbase and things like that, where the amounts that we're trading aren't really enough to create any liquidity risk. But if you are a really large player, you would need to take this into account, because not being able to put in a large order without moving the price and therefore changing your risk profile is really a concern for that. And so the last thing I have on here is volatility. And of course, you can measure volatility on anything like volume and whatever, but specifically, I'm talking about volatility on price. So that's the main thing that we're concerned with when we're trying to manage our risk of loss, is we're managing the risk of loss of dollars or whatever currency that we're using. So that's going to be price volatility. Okay, so to move on, we want to bake in our risk management from the very beginning on the, during the definition of our trading strategy. So we want to define it in such a way that we are going to be able to manage the risk. So the first thing I have on here is, managing our risk to reward ratios. And actually here, let me just kind of pull up a few others. Our risk to reward ratios, which I'm going to tell you how that's misnamed here in a second as well, is for a given amount of risk, how much reward are we expecting? And we want to manage that ratio. And then also, what is the required win rate to make us profitable given a particular risk to reward ratio? Okay, so let's just take a look at a couple slides on this. By the way, so here's firstly, I said risk to reward is misnamed. A lot of people don't believe me on that, so I actually went and asked ChatGPT, and as you can pause the video here and read through this yourself. There's my logic. And so at the end I said, so shouldn't it be called reward to risk ratio? And ChatGPT said, yes, you're absolutely right. That would make more sense, but that's not what people do. So it's a little misnamed. Don't let that confuse you. What it means is, as long as the number is larger than 1, then you're getting more reward than risk. If the number is less than 1, then you are getting more risk than reward. So we don't want that. We want to be 1 or higher, preferably 2 or 3 or much more than that. Okay, so with the risk to reward ratio, or what they're in this chart they're calling the R multiple, you notice that like let's say that we have a 1-to-1 risk ratio. That means that we need to have a win rate of at least 50% in order to be profitable. Now these are averages, okay? So they're going to change over time, but let's say that our R multiple was 2. So whenever we place a trade, our expected reward is twice as much as the potential loss. Then we only need to win 33% of our trades to be profitable. Now you don't want to win just 33%, because you'll then be right at break even. So you want to win a few more than that. But one of the things I kind of want to bring up here is a strategy that I used to use. Getting some space here. A while back, and I still do this trade, but it's changed slightly. It's not quite as lucrative as it used to be. Is if we take a look at a traditional impulse wave, like a standard Elliott wave style impulse, like here we get a triangle. So we have wave 1 up, 2 retrace, 3, probably a triangle here in the 4, but I'll just draw it like this, and then a 5. So the way the trade works is, we're following algorithms, and these algorithms tend to enter after a retracement of 50% and down to the 0.618. Okay, so the way I drew this, in between these two lines would be the place where the algorithms are entering their longs. Now, back in the day, Sam Eels, I think it is, figured out that it seemed like a lot of these algorithms would take the trade all the way down to the 618, defend it through what he called the golden zone. And everyone knows what the golden zone is now, but no one knows who to attribute that to. And it was Sam Eels, also known as Trading Devil. And so if they crossed, if they broke this 0.65, they would basically get stopped out of their trade, and they would look to enter going in the opposite direction. So one of the great things with this trade was we would have a limited entry area that was very close to where we could place our stop loss. And so what I would do is enter, let's see right here, enter the trade, like about right here, get out of it just on the other side of the 65 right there, and take it all the way up to here. Now that all the way up to there, if I correctly identified that this was a wave 3 for Elliott wave, I would expect it to go to this -1 as a target. Okay, so it went a little too far there. This should be more like this. Okay, something like that. And so I would target probably somewhere like right about there. So if you look at this, this is a 20.47 risk to reward ratio. So I could lose 20 of these in a row and then make one, and I'd be at break even. So all I'd have to do is do better than 20. And actually what I was averaging was about 10, or yeah, maybe like 7 to 10, where I would lose 7 and then you win 1. But because this ratio was so good, that was okay, and I was still making money. Now this trade has kind of gone away, and just so you know, I'm kind of foreshadowing a different session that I'm going to actually be doing. But now, actually I have a template I think I can use for this. Now what you'd probably have to do is give it further down to what they call the platinum zone, to the 707, down to about there, and you'd have to take profits at all three of these levels. So on average, you'd probably average around here, but you see it's still pretty good. It's 7.5 to 1, and that actually is exactly what I've been getting on these types of trades. So there are trades, it is possible to be profitable with lower win rates. You don't have to be 50% or higher, like most people think. Okay, now let's talk about losing streaks, the probability of having consecutive losers, and how that affects drawdown. So let me go right back here. So losing streaks, the number of losers that you have in a row is going to significantly impact your loss of capital quickly. So as you see here, if we only put 1% at risk, then I can have 10 losses in a row and I'm actually losing slightly less than 10%. The reason the number goes down here is because as you lose each one of these, if you're using a scaled risk percentage, you know, your account size is going down, so you're actually risking less and less as each one of these goes on, for losers in a row. But notice if you're using like 5% risk, then even right here, after you lose 5 in a row, you're getting into areas of significant drawdown on your account. You know, for me, drawdown, and here's a chart that kind of shows, I'll come back to that one in a second. The drawdowns, you know, the recovery rates that are required for them, like everyone knows this one. So if you go down 50%, you have to go back up 100% to get back to even. And so as you get down here, it just becomes harder and harder to recover your account the more you have drawn down. And also remember, if you're using a percentage risk strategy like I'm going to show you here in a minute, then as you get drawn down, you're using a smaller and smaller position size, which means it's going to take you longer to even reach these recovery rates. So, you know, for me, on any particular trading strategy that I define, I start getting concerned and worried when my drawdown is at 20% or more. And so that's when I start really paying attention and, you know, trying to determine, do I need to rerun numbers, and, you know, what are my actuals versus estimates and things like that. Once it gets to 50%, then I'm done. That trading strategy is dead to me. I'm not going to continue running a trading strategy that has drawn down over 50%. Now, that's not to say that it couldn't have turned right around right after I made that decision and made a ton of money. It's possible. It's not likely. It wouldn't be a very fun road. Anyway, I would rather just scrap that trading strategy, start over again with, you know, at whatever point that I'm able to. Now I skipped one slide. Here is your percentage probability or likelihood, and actually those two words do mean different things. So the likelihood of consecutive losses based on your win rate. So the only point I wanted to make with this chart is that the higher percentage win rate that you have, the lower the chances are of you having consecutive losses. They're never really zero unless your win rate is 100%. Whoops. But as you can see, if you have a 50% win rate, you can lose 5 times. There's only a 3% chance that you're going to lose 5 times in a row. Whereas if you only have a 30%, you know, chance, you know, the chances are fairly high that you're going to have consecutive losses in here. Anytime you go below 50%, that's going to be the case. So what you want to do is you probably want to stay in the green. Those are safe regions as far as win rates go, unless, I mean, or you're just aware that you have a high potential of having consecutive losses, and if you plan for that, then that's fine. It is more than anything else a psychological planning for having consecutive losses and a large drawdown. It might work on paper, but psychologically, it is very difficult to stick with systems like that. Okay, so position sizing now. When you're designing how you're going to build your strategy, I always suggest that you use a scaled risk. So you notice here you have a percentage versus dollar. So you could risk the same dollar amount for every trade. Let's say every trade you do is $5,000. That's not as flexible as using a percentage of your what your account size is, because then it will automatically get smaller when you are on a losing streak and get bigger as your profit goes up, and really exponentially allow you to increase the size of that account, while on the other side, if you are losing, it starts, you know, hedging against your losses because you're using smaller and smaller position sizes. Now, I'd like to take that one step further and not only use a percentage of my account size, but what I use is scaled risk, which means the loss value is calculated as a percentage. So for every trade I take, there is a percentage of my account is the maximum amount that I'm going to lose based on where I placed my stop loss. Okay, and that's usually 2%. Sometimes it goes up higher. Okay. Now, expectancy is just another calculation that we can use. Here's the formula. Win rate times position size times R multiple. I bring it up because it's bringing all three of these different variables together that we've been talking about. So here you see there's an example, 55% win rate, 2% position size, and they're using this as 2%, not of loss potential, but 2% of your account size. So it's slightly different. And an R multiple of 1.5. So here they filled them into the formula and they came out with 0.75%. What that means is that over the long term, when you look at all your trades and what the returns of those trades were, they should average to 0.75%. If they don't, then that means that your actual win rate, position size, or R multiples were not what you thought they were. So they have varied. So what's useful about the expectancy formula and using this is it's a way of quickly checking if the assumptions that you're basing your trading strategy and your risk management on are still valid. Okay, so you build this up, you get your number, and then maybe after 25 trades, you go back and you check to see what your actuals are, what your actual expectancy should have been. And if it's higher than this, then that means, well, maybe you were a little bit too conservative with these numbers. And if it's lower than this number, then that means you were probably too aggressive and you should probably go back, put the actual numbers into this into your whole trading strategy, and come up with a new measurement here for this. Okay, see if everything still makes sense. All right, going back. Another way of measuring these things in your trading strategy is the Kelly criterion. It's just a different way of deciding what your position size, what your amount to risk per trade is. It's also used by gamblers a lot to decide how they should bet each hand, how much they should risk. Here I have a calculator built in. You can just pull up a Google search for Kelly criterion and you'll find calculators online. So the way that this works is you pick you put in your win rate and your risk to reward ratio. So let's say that, for example, I'm going to put 30% in here, and let's say that my average risk to reward is only 2. Okay, so notice how here this returns a negative expectancy, which means you should not trade. These two numbers are not compatible with each other because they do not produce profit under any circumstance. Okay, so let's rewind. Let's go with a different trading strategy. My win rate is still going to be 30%, but now my average risk to reward ratio is 5. Okay, and from that it tells me that the Kelly ratio is 16. What this is saying is that if everything is perfect, if my averages for all my trades average to 30% win rate, so I win 3 out of every 10, and my average risk to reward is 5 to 1, which means for every 1 unit of risk, I have 5 units of upside potential, then my Kelly ratio is 16%. So it's saying that I should risk 16% of my account on every trade, and that will produce the maximum optimal return for me. That's not to say that in actual use you should risk 16% of your account on every trade, because these numbers are hardly ever perfect. Okay, so instead, like let's say that you win the first one and then you lose 4 in a row. That means that your current running win rate percentage is actually only 20%. Okay, and so at that point, if you have been risking like a high amount, you're gonna be down, and if you get down significantly, it's gonna be hard for your account to recover from that point. So instead, what they say is that the recommended risk per trade is generally a quarter Kelly. So take this number divided by 4, that gives you 4%. Okay, for this particular trade setup. usually the Kelly criterion generally returns a little bit higher percentages than I'm usually comfortable with, but it is another tool that you can use that is very well known. All right, so moving on here. Oh, and so while you're designing your trading strategy, you're gonna have to validate with backtesting to come up with these initial numbers. But then once you actually start trading for real, you're gonna put your actual numbers in after you get in, 10 to 20 trades, and then definitely like every 100 or so to double check. Especially if you notice that the market has somehow changed. Okay. I want to talk quickly about entries and exits. And just here to talk about, there's two entry types. There's breakout trading and there's retracement trading. Basically, and there's also volatility trading, but we're not talking about that here. So with breakout trading, you are basically waiting for like a support or a resistance to break. And then once you get on the other side of that, maybe you come back and test it once, then you put in your trade and you're off to the races in that direction. Whereas a retracement trader waits for a pullback and tries to find the reversal points for that trade. I would place myself definitely in the retracement camp. They both have their pros and cons. With a breakout trade, the price action is at least already going in your direction, so it has momentum. But the problem with breakout trading is the risk management aspect of it, because it's difficult to know where to place your stops. For instance, let's say we've been trading within a range and we break out to the top side of it, and so we put in a long. Where are you going to place your stop loss for that? There might not be any structure other than at the very bottom of that trading range, so that's going to place your stop very far away from where your entry is. Or you could place it just on the other side of where the breakout was, but very often we come back and test, back test those supports and resistances, so that'll probably take you out of your trade. I know a lot of breakout traders, they either go with no stop loss, or they will just choose something arbitrary like a percentage loss, or they'll decide where their target is, and let's say their target is 5 units, 5 pips, or whatever, $500 above where their entry was, and the RR that they built into their trading strategy was 5-to-1, so therefore they're going to place their stop 1 unit below where their entry was. Again, completely arbitrary. That's not really based on anything. I don't like that. With retracement trading, you have to pick where the reversal is going to come, and so momentum is in theory going in the wrong direction for your trade. However, and there's ways to mitigate that. I mean, if you do this type of trading, you know how those entries work. But the nice thing about them is you can generally place your stop loss just below wherever that reversal point was, or that reversal range was, because in that case you're coming down. In the case of a long, you're coming down to support, and so you could place your stop loss beneath that support. And if you break that support, then you know that means that your trading idea is wrong. Okay, so one of the two things I just talked about there is it's better to fail fast, or fast fail, whichever way you want to term that, which means you're placing your stop loss as close to your entry as possible without, hopefully it getting hit, because that limits your loss potential. Okay, the closer it is, the less you're going to lose when it hits that stop loss. And at the same time too, I'm going to skip that for a second, that I guess what I want to say here is that you are limiting the time and space that trade exists in. Okay. As far as different types, this doesn't really play too much into risk management, but there are different types of entries and exits, so I thought I'd mention them because I get asked about it all the time. The thing to know about market orders and market entries is that they do guarantee execution, but they don't guarantee a price. So the good thing with them is that you'll always get an entry, unlike with a limit order where you may or may not get filled. But with the market order, you may end up getting filled at a price that you didn't anticipate. So it's not going to be the best price, and it may be farther away from your stop loss, which means there's more risk. and it's going to reduce your RR ratio and so on. So there's that versus a limit, which gives you a known price. However, you don't know for sure that it's going to get filled and hit because the price might reverse before then. So a way to mitigate that is to use a range entry approach, which I'll talk about here in a second. The last type is a chaser, which sometimes it's called an aggressive limit order entry. It just means that you're going to use a tool to place limit orders like right below or right at the tip of the spread on the buyer ask side, so that you are always, in that next block of orders that gets filled. If the price is going in the opposite direction, it's going to go away from you, but it's called a chaser because it chases the price. And we know that candles don't go in a single direction forever. So if you have a chaser set to be one tick below current price, it is eventually going to get hit because the price is going to kind of click back at least that 50 cents in the case of Bitcoin, or whatever the tick spread is for your instrument that you're using. As far as like which is best to use in like highly volatile times, I've heard a lot of people say, well, market is the only type of order that you can even get into in those cases because it's hard to place limit orders in like fast moving markets like that. That's true, but since you can't be guaranteed of a price, you will almost be for sure going to get the worst price, and you will get filled at the tip of a wick right before that candle goes in the other direction. Trust me, it always happens. So there's that. Limit orders, you're right, they're very difficult to place when the market's going crazy and the exchanges are super busy processing orders. The best thing to do is to place your limit orders prior to the market going crazy. And then they're just sitting there waiting to be filled when the market happens. And as far as, we don't know where the reverse is going to happen, but that's why you use a ladder spread entry approach. Chasers do not work well at all in times of market volatility because they require a price feed to be coming constantly from the exchange to your tool that you're using. And it constantly has to, maybe multiple times per second has to change your orders around, and those don't always get processed in timely fashions, and you'll end up probably seeing a lot of errors if you're trying to use a chaser during high market volatility. Okay, so scaling in and out, this just means, instead of trying to pick a single price for doing your entries, usually you have a range in mind, so create multiple entries across that range to scale into your position. And maybe they'll not all get hit, but that's okay because you've mitigated the risk of it. Like if you only had one order, then that one order might not get hit, in which case you are out of luck. Whereas this way you could build the range, extend it a little higher, a little lower, and then maybe you'll get at least some fills. Maybe you'll get all the fills, or you get most of the fills. Of course, usually when you get all the fills, that means you're like probably pretty close to your stop loss. Too. So that's another thing we'll talk about in that stop loss section. And also remember that you can scale out of positions as well. I'll admit I don't do this as often as I scale in, but it is a valid approach to risk management because risk management isn't only about minimizing your losses, but it is also about maximizing your gains, and scaling out is one of the ways that you. Okay, so that takes us to stop losses. And the first question is, well, why do we use stop losses? And that's a basic question. We use stop losses to stop our losses. So that is to mitigate or minimize the losses that we are incurring when price action goes against us. As far as when we define our stop loss, I think you should define your stop loss prior to a trade execution. So before you enter a trade, you've defined where the stop loss should be. If you don't put it into the interface to actually like put in a hard stop loss into the exchange, that's fine, but you should have defined it for yourself so that you know where the exit is going to be. Also, as you'll see here as we get into position sizing, that's like the core of my approach to risk management, is that I use my stop loss to define my maximum risk per trade. So I have to define my stop loss prior to the trade going in. Doesn't mean I have to actually like officially put it in on the exchange. I just need to know where it is so I can do my calculations and be ready to execute that stop loss when the time comes. Okay, so for me, a stop defines the invalidation point of a single trade idea. so I define its placement based on when the price action reaches this point, then I know that my trading idea has been invalidated. It was wrong. I need to get out, okay, and minimize my losses. So because of that, a lot of times if let's say that you're trading, you have confluence for an entry point based on different trading ideas. This is something, because I've traded so long and I've used so many different systems, I find myself doing all the time. I'm mixing these, and that's usually a strength, but one place where it does cause issues is it makes it difficult for me to define where I want to put a stop, because those different trading ideas that I have coming together all perhaps have different invalidation points. And I don't know what to tell you about that, because I'm still struggling with how to deal with that myself. I just know that it is clearer risk management when you only have a single idea that you're placing that. Now you can get confluent signals, but you should have one main rule set that you're using for your entries that helps you define where you should put that stop. And let's say that you're doing something really like basic support and resistance type trading, or supply and demand, something like that, where you have multiple ranges that you could possibly do entries in, and your plan is to DCA in as the price goes up. So you're going to continue buying or continue shorting, as the case may be, as it's going up or down. If there's a large distance between those ranges, and you're pretty sure that the price isn't going to reverse like somewhere in between, like if it breaks through the first one, we're going to the second one, and if it breaks through that one, we're going to the third one, etc., then I would highly suggest that you treat those as separate trades. So if we get into the zone of the first entry zone and we break below it or above it if we're shorting, then that means that that idea was wrong. And so I would, at that point, get out of that trade, stop loss it out, and then wait for price action to go down to your next area of interest. And then get in those trades, which that does a couple things. One, it keeps those trading ideas separate and manages your risk at each point. Yes, there is a risk that for some reason that you weren't aware of, the price does decide to reverse halfway in between. But if it does that, then your TA is not like really on point, because like you shouldn't trade just because you got lucky on something. I mean, we all take it. And we all have traded and we've been lucky. However, that's not something to base like a strategy around. So if you're wrong, you're wrong. Get out of the trade. Let it go to the next level, and then get in to that trade. Again, this is my approach. Doesn't mean it's right for everyone else. Some people prefer to just DCA in, I've seen people that where their whole strategy is as it goes down, or as the price action goes against what they think is going to happen, they not only get in more, but they increase their position sizes as it gets. So the more wrong they are, the more they put at risk, which to me is a little bit backwards. But again, you guys do you. I'm just telling you what has worked for me in the past, what I've tried. And by the way, I have tried that whole DCA thing a ton of times. I used to run a lot of automated bots, and that was like their whole thing was they DCA'd down, never produced a loss. That like didn't really work out how I thought it would. Let's just leave it at that. Okay, so there's different types of stop losses. We have hard stop losses. These are the kind that you put into the exchange, and as soon as the price, whether that be the mark price or the current latest price on the exchange or the index price, however it's defined on there, you can usually pick. And there are different reasons why you may pick one or the other. But anytime the price action even touches whatever the point is on that, then your stop loss triggers. Okay, so that's a hard stop loss. It's usually put in as a conditional order on an exchange. Sometimes those are just called stops, but in other cases they're called conditional orders because they go in the same direction as the trigger. Soft stop losses are where you have a stop loss where maybe your strategy defines it as, well, I'm going to close my trade if this candle on this time frame closes below a certain point. So in that case, there's not a lot of exchanges that support that. but there are a lot of tools that do, whether they're trading station tools like 3 Commas has one, or you could use their bots to do that sort of thing. I'll show you the one that I use later on that can do that sort of thing, and I'm sure others that are out there can do the same type of thing. So that's a soft stop loss. And then you have dynamic stop losses, which the most familiar ones to people are trailing stop losses, which just move up or down in the direction of your trade as it's being successful, and they don't move when it's going against you, and so eventually they will meet and the stop loss will trigger. But I do want to mention that there are other types of dynamic stop losses that if you can automate your tool, or like the way I do it is I use indicators that I have in TradingView, and I just have them send a webhook to the tool that I use to trade. And so I can use any indicator to get in and out of trades that way. My favorite to use is one that I built myself, but a lot of people use like the PSAR, the parabolic support and resistance trade, or there's a chandelier stop that I know a lot of people like. You could even like take a moving average, like the 50 moving average, and if we close below it, then decide that's when your trade should close. So there's a lot of dynamic types of stop losses that you can use, but you don't have to be that fancy either. As long as you're using some type of stop, then you're fine. Okay. I'm not going to talk about these again, other than to say that for stop losses, almost always you want to choose a market stop loss, because when you are using a stop loss, you are limiting your risk and usually closing out your position. So the market stop loss is the only one that guarantees that will happen. Whereas a limit order, you could go past the trigger point, it sets the limit order, and the price just keeps going in the wrong direction, and your limit order never triggers, and you just keep losing and losing. So that's not really a protection to be used as stop loss. Now, if you're using a stop loss because you're very far into profit and you're using a trailing stop loss, then maybe those are fine to use as limit orders, because if they do go past them and they don't trigger, well, you have time, you can get in there and maybe set a limit order and then set a lower hard market stop loss at some other point in case it has gotten lost. You can use chasers too. I only use those ever if I'm looking for an exit, which is usually not a stop, but it's hopefully in most cases a take profit, and I'm actively managing the trade, so I can use a chaser and manage it. All right, and one of the things that people don't also realize is that it's obvious to us when we're talking about taking profit that we can scale out of our orders, or our positions, and take 50% profit here and another 25% a little higher and so on. But what people don't realize, they can do the same. You can do the same thing with stop losses. You don't have to set a single number and take the full amount of your loss all at once at some arbitrary point or some calculated point. You can set multiple stop losses up to scale out of your loss, if you will. And that's a way of managing risk and minimizing that loss as well. Okay, while maintaining some hope that the price will eventually reverse and you won't be completely out of your position because of just a stop run. Okay, last question here: when should you move your stop loss? My simple answer is I don't ever want to move my stop loss in a way that increases my risk. So I try to define my maximum risk at the point of the entry of my trade, and I do move my stop loss when I have new information to look at. So that new information is more candles have formed. I can now, it's a different picture than it was when I entered the trade. Hopefully I'm in profit now at this point. So now I'm not managing just the amount of my trade, but I'm managing the amount of my trade plus the profit. So it's one thing to lose whatever your entry was. Let's say your entry was, I don't know, $2,000 trade. But let's say you're way in profit now, and now it's $10,000 worth. So now you're managing $10,000 of equity and possible loss. A lot of people like to say, oh, well, we're in profit now. It's house money. I don't care if I lose it. Well, that's fine for some people. It's not fine for me. If once you're in profit, that's your money to lose. you just have to take the profit. So yeah, that's how I look at it. Okay, so here's the big section here that we want to talk about is how I do position sizing. This is going to have interplay with stop losses because, like I said, I set my position size based on where my stop loss is and where your RRs are, and what you've defined as your maximum loss per trade. So use a dynamic position size based on a fixed loss percentage per trade. This is going to make a lot more sense here when I do the demos, because I'm going to do 3 demos for you. I'm going to first look at using the tool that I actually use on a day-to-day basis, Bybit Pro. It's a paid tool, but you don't have to use a tool like that that costs money. But I do know a lot of the tools that people have been talking about and using. Like I know Teal Street, I think, has a similar function to this. I know it does laddering, so it probably does the risk calculation too. If not, it probably will soon. There are lots of other tools. I used to use one called BitMEX Helper or something like that. So they all kind of work the same way. You can use that. I'm going to show you how to do that since that's actually what I do. But then I'm going to show you an old spreadsheet that I used when I was kind of starting out trading on BitMEX that does the calculations for you. So just to show you that you can build your own. And I will make mine available to you, although there's kind of a weirdness with that. So I'll talk about that when I get there. And then I'm also going to show you how to calculate it from scratch, because it's not a hard calculation. And you should be able to do it. So let's take a look. Okay, so here is Bybit Pro. And this tool, there's a lot of reasons that I use it still. I mean, one, because I bought it, and that's what I own. But I think there are actually better terminal tools out there right now, or at least more feature-filled tool sets. But this one does everything that I need it to do. And the biggest feature that I love about it is the ability for it to integrate my own TradingView account, not their TradingView account, right here into the interface, which means I can use, I have a premium account, so I can use all of my indicators, because I've built a ton, and it'll have all of my charts that I use when I'm doing all my other analysis, available to me right here. So that's the benefit. Now there's a downside to that, which is, you'll see in a minute, like when I place a bunch of trades, they're not going to show up on the chart for me because it's not integrated into their tool. It's just showing me a little window into my TradingView charts, via a web interface, basically. Okay, so if we're going to do a ladder order, this is how I would approach it. So let's say here I see this price action doing this thing. Let's see. I have a couple order blocks down here. I don't want to actually place my orders too close to price action because I don't want them to execute during so I'm not exactly going to be setting this up how I would do it for real, but we're going to kind of create a little an example here, if you will. So I'm going to target this order block that's right here, the lighter colored one, not the darker colored one, and say that I want to start entries here at 22,804. So I'm going to put in 22,804, and I want to buy down on my long all the way down to, I don't know, about here-ish, 22,626. I'm going to skip the quantities for a second. I want it to place 10 orders in that small region, and my stop loss I'm going to place down on the other side of this other order block. So 22,439. All right, and for my scale, let's say that I'm kind of expecting that it may just, kind of do what these have done, which is wick in and then come back out. Like this one only wicked to the very tip of there, and then it came back out. So I want my higher valued entries to be at the top, not at the bottom. A lot of times I would want them at the bottom because that allows me to use a bigger position size, because then my average entry would be closer to my stop loss. But in this case, because I'm expecting it to just maybe like wick in and come back out, I want the biggest entry to be kind of towards the top. So I'm going to set this to be decreasing in size. So the highest one will be up here, and then they'll decrease in size on the way down. All right. Now I think this is a test account that I'm using. I think, yes. So it only has $305 in this account. So keep that in mind as we're talking about sizing here. So the entire size of this account is only $300. I'm going to set my risk percentage to, let's make it, well, let's use 5%. Okay, so I set that, and notice down here, it's already taken the values that I had over here and calculated based on this stop loss price, and this is the distance to entry, and this is 1.14% is the distance in percentage. That for $305, my maximum amount at risk that I want to have at 5% is $15.26. We can verify that that's doing the calculation right. 305 times 0.05 is 1525, so it's close. You see here, because I've got 19-20 cents extra in there. And then it adds fees in here. So my loss, if I get to the stop out point, is only going to be $16. So I'm good with all that. I'm going to hit fill. And what that does is it changes the quantities here. So it's saying that, okay, based on all that data, your position size should be $1,200.94. And you notice, what is that? That's like 4x. So I'm using like around 4x, maybe 4.2x leverage on this trade. So this is the total size. But I told it that I want 10 orders, at decreasing scale. So what I have to do is, so this is actually a buy. That's why these aren't lighting up. If I preview this buy, notice that it's placed them for me here, starting at this price and going down to the bottom price, and the quantities are decreasing. So the highest value ones are up here at the top, and then they decreased on a curve down here so that the lowest value ones are down here at the bottom. Okay, and all I have to do is click confirm, and it'll actually place all of these orders for me. All right, let's see, close that, and here you can see all my buy orders that are in, and they're ready to go. So if this comes back down here, touches that, then I'm gonna go. I didn't define my target profits and take profits. I usually don't when I'm placing the orders, because you usually have some time to set them, afterwards. We're not usually gonna touch down here and then immediately hit our target profits. And the reason I like waiting then is because then you can make the decision on where to place your TPs based on more data, because more candles will have been created by the time that your orders get filled. Okay. Now I'm going to cancel all these so I don't forget about them later and go on. So that's using the tool that I use, on a daily basis when I'm day trading for that. Now let me show you. I also have. I'm gonna actually go ahead and close that. I have this spreadsheet that I made years and years ago, like about 5 years ago, to help me trade on both Kraken and BitMEX. And so with this, it kind of works the same way, except this one's a little bit more sophisticated. Not more sophisticated than what I just showed you, but more sophisticated than what I'm going to show you next, in that it'll calculate all the fees for me as well. Because this is BitMEX, you actually hold your collateral in Bitcoin. So it's a little different than like if you're trading the USDT or USDC futures pairs on Bybit, but it is exactly like if you're trading BTC USD. So here I've defined this, and notice you just put your entry price in and your stop loss, and then I hit this auto set button, and of course you didn't see any changes because I didn't change anything. Let's just make a basic change here, like 125, and let's say that this is going to be something like 26,000. Whoops. Okay, so I hit auto set, and it changes my position size automatically for me, so that my max loss is exactly 4%, or in this case it's 10% of my account size, which is $10,050. Okay, so that's why it's almost exactly 10,004.98. So that's my loss at the stop. And then if these are my target profits, then that's my target profit. So this is a 4-to-1 risk ratio. looks pretty good, so we can execute it. Now, I'll make this calculator available to everyone, but there's two catches. The first catch is that one, it uses macros, and I would highly recommend that you not ever like run Excel spreadsheets that have macros embedded in it from people that you don't know, because you don't know what's behind there. So it'd be hypocritical for me to send this to you and tell you, yeah, it's okay to run because it's from me, but don't do it for anyone else. So for that reason, I probably wouldn't recommend it. You can actually use this and not enable macros. It's just that this button and this button won't work then, which is the primary reason. Like this one here is the primary reason I'm giving it to you, so that you can calculate it. I will tell you that all that macro does is that it does a goal seek on it. And the reason I have to do a goal seek here, and we're not going to do one on the calculations next, is because this one takes into account all of the fees. And as you change these numbers, the fees change as well. So it has to take that into account to keep the stop loss stable and set the position size. So I could solve that by making the, unlocking this so you could see all the formulas, and then you would be able to also go in here to Visual Basic and see the macro code. However, I protected these all those years back with passwords, and I don't remember what the passwords are. So I am actually unable to unprotect them at this point. So anyway, I would say, I mean, it's a great tool, but I can't say that you should use it. Okay, so let's take a look at this. To do this calculation, you're going to start with a particular account size. We'll make it $3,000, and you'll need your mask risk percentage. So let's say that's 2%. So the first calculation you need to do is define how much dollar amount you're going to put at risk per trade given this account size. So that's just going to multiply the 2. Max risk percent, and that is because I said percentage, let's make that percent. There we go. So $60 for every trade we do. While we have $3,000 in here, we're going to put $60 at risk. So the next thing we need to know is what is our entry. So if you're going to have multiple entries, then of course you'll need to average, add them all up and then divide by how many there are. But I'm just going to define, let's just say that I know my average entry here is, let's call it 23,400, something like that. And where you're going to place your stop loss. So we're going to do a long. So we're going to place our stop loss under there, and let's make it 23,121. Okay, so the next set of calculations you need to do is the distance to your stop loss minus the stop loss. And keep in mind that if you're doing a short, you'll have to reverse these two or take the absolute value of them. That's probably better. Let's just do that. I think I have ABS. I'm not positive that that's active here in this environment, but we'll see. And because we want it as a percentage, we'll go ahead and divide it by average entry. Okay, and as you see, this is coming out to 1.1923%, but I'm going to take that percent off to just leave it in its decimal form like that. So remember, I think this is working, but if you're not using a calculator like I have here that supports that, then just reverse these two. So do stop loss minus average entry if you are doing a short. Okay, so that means our total position size will be our max risk, because that's the maximum dollar amount we want to risk per trade, divided by the distance to the stop loss there. So as you see, it's suggesting that we should be using a position size of $5,032. So that's going to be what, a 1.66x leverage. So not very high. It is higher than our full account size, but not terribly so. But the important thing is what it's defining is that if we create our trade at this position size or average entry, at this value, then if we hit our stop loss, we are only going to lose $60. Okay, so which is 2% of our account size currently. Now, just I didn't mention this before, but this tool I'm using is perhaps one of my favorite and most used shareware tools that I've ever used in Windows, for the last 25, 30 years. Because I use it every day. It's great, but it's just a calculator. So you can use any calculator or spreadsheet type tool that you have. Of course, if you were doing this on a calculator every time, that might become cumbersome doing those trades, but having something like this, very simple. You mean every now and then you'll have to update your account size because hopefully it's getting bigger, but it could be getting smaller too, I guess. And then just pop in your average entry and your stop loss, and it'll spit out for you right there what you want, what your total position size should be. It's pretty quick. So if you're using a spreadsheet, very simple to do those as well. Okay. Let's go back here now. The next section I have to talk about is hedging, which I don't want to spend a lot of time on hedging because it's not something I do a lot in this context. But I didn't think I could create, a session on risk management without a hedging section because it is an important concept to have in here. So the first thing to talk about is what's the purpose of hedging. We hedge when we have a position in something that we don't want to close, but we want to basically, create an opposing position that will, keep you from keep increasing your losses. Now, if you make them the same size, then you won't have any profit or losses. But it is also possible to do partial hedges and only hedge a portion of it, and then the amount you are losing will be reduced, but it won't completely go away. Okay, but the key there is that this is something that you do when you want to keep a position open for some reason or another. I'll go through some of the ones that make sense here in a minute, and then I'll also cover some that people talk about and use that I don't think make any sense at all. Okay, so different types of hedging. The classical one is when we have spot versus derivatives. So the way that this works is, let's say that you are holding BTC in the bull market and it's gone way up to 69,000. Now it's coming down. We're at 50,000, and you think we're entering the bear market. But it's your spot hodl position, so you don't want to just sell it with the hopes of then buying it down at the bottom because everyone says it's going to 100,000. So why would you sell now? So you're going to hold on to it, but you are suspecting that the bear market's coming along, so you want to hedge it. So one of the things you can do is sell a portion of it, like let's say 20% of it, or just bring in new funds that are equivalent to 20% or so. And let's say that we've done the sell. So let's say we had a position of size of $50,000. So 20% of that's 10,000. So we now have 40,000 in spot, and we have 10,000 that we've bought as a BTC short in a futures market, and we use 5x leverage on it. So no, 4x leverage. 4x leverage on it. That way we have equal sizes, right? 40,000 for each. Then as the market goes down, your short is going to increase in value while your spot position decreases in value at the same rate. So you're hedged there. You're not going to lose any money as you go down. Then when you reach the bottom of the bear market, you're going to, you think you've found the turn, we're back into the bull market. Then you just, close your short position and ride it back up. So, you'll still be at $50,000 at the point you make the sale, but as you then go back up, your spot position will increase. So that a lot of people use that strategy for kind of going through cyclical markets like that. Next I have on here is correlated instruments. So this would be something like where you take two instruments that are correlated, like say BTC and ETH, or if you're like in the stock market, usually people use indexes for their correlated instrument. So like if you had Amazon stock or Tesla stock, you might hedge that with the SPY index or Dow or NASDAQ, something like that. So one of the things to keep in mind is usually if you are long in your primary position, then you would want to hedge with a weaker instrument. And by weaker, I mean probably lower market cap and subject to more volatility. So that's why I said, like, if you were long BTC, you might want to short ETH because the idea is that as it goes against you, you will probably have the ETH is going to go down more than the BTC in notional value. So that gives you the wiggle room that you need to cover the fees and like the getting in and out of the trades as things turn back around. Now, if we're going up, you might say, well, isn't ETH going to go up faster too then? And yes, it is true, but probably if you're going in the direction of your primary position, you're going to drop the hedge. You're going to close that position, so that's not really as much of an issue. So if you're going short, if your primary position is short, you'll want to do the same thing, but you'll want to use another instrument in the opposite direction that is also more volatile. So if you're short ETH, you might want to long BNB or something like that. Okay. Non-integrated inverse positions. What this means is take the same instrument, like say BTC USD, but either on two different exchanges or in two different markets. Like maybe you have BTC USDC and USB USDT on the same exchange, and they are in opposite positions. One's short, one's long, but they clearly have their own delineated set of trades, and you trade them as such. So you can kind of keep them straight. They don't really affect one another, but overall you are making money on one and losing money on the other, and so therefore it's a hedge. Okay. Next one I have here is some exchanges support a hedge mode that allows you to open both long and short positions on the same instrument. So like Bybit, you can switch it to hedge mode on anything, and you have to actually make that change per instrument. So just because you change it on BTC, if you go to ETH, or if you go to BTC on like one of the other, like if you did it on USDT, when you go to USDC, you'll have to do it again. So it is a setting that's set per instrument. And it does let you just keep that long and their short open at the same time. I find this highly annoying because it limits what you can do as far as scaling in and out of positions with the opposing the opposing side. So you can do it because the UI does change on the website. So you actually have to specify if this should open or should close a position. At least that's how it works on Binance. On Bybit, I don't remember if they give you that option, so it just could be that it's just going to open another new position. So instead of reducing the size of your primary position, it'll just open another one in the opposite direction. It's possible that they've changed it now because everyone complained about it. So you might be able to specify if it should open or close now. But with that, it I think still limits the use case of using shorts and longs against each other. Another thing that you should keep in mind, and I'm going to talk more about this in a minute, is that there aren't any really good reasons to hedge like in this type of inverse perpetual, because what is the reason that you want to keep that primary position open? And I can only think of one reason. Because the other thing you could do is just stop loss it out, right? Close your position, buy back in at a better point. Well, the way that some people's thinking goes is that if let's say that they opened a long BTC and we went down, okay, or if let's say they opened a short and we went way up, that's better. So we opened a short, we're going up and up and up, we're getting worried about our position, but instead of stop lossing it out, we open a hedge position against it. At this point now, you are paying fees on two different trades, both exit and entries. You don't have to worry about the funding fees too much because they'll cancel each other out. But why are you holding on to that first trade? Why didn't you just close it? Well, the reason that most people do that is because they think it is going to go back down their way eventually. They just have to like give it a little bit more time. And what they're afraid of is that if they were to just stop loss or close it out, then at that time that it goes against them and then it comes back, that the entry conditions won't satisfy their particular trading strategy anymore, because like the entry just doesn't look good. Now, to me, that's probably a trade that you shouldn't take, because if that doesn't look good to you, then why would you take that trade? So, but psychologically, that's why you would just keep it open, and then when it comes back to that spot, then you drop your hedge and you're going on your merry way. And so you were right. The other thing to consider, and I'm going to get to this more in a minute, is that capital that was used as the margin for the hedge might have been better served as liquidity to allow your your position to go into a bigger drawdown. In most cases, that's not what I would say. I would say, just close the position, but it's possible that could be true. Okay, I'll talk a little bit more about that in a second. Last thing here is options. This is probably the best choice for hedging, because it gives, the nice thing about options is that it gives you the option to buy or sell at a given price, but not unlike opening a position, it doesn't make you commit to that until the expiration point of that option. So you can kind of collect more data as time goes on and see what makes sense. I would not suggest selling, or going what they call going short on options, whether it's a call or a put. Don't sell them, because that gives you unlimited exposure, and that's why most exchanges require you to have extra collateral for that type of thing. However, buying options, whether they be calls or puts, a lot of times the ones that people use are the protective puts and the covered calls. That gives you the hedge position against another position that you may have. So whether that be a long or a short, usually it's a long spot position. Then you use options and use puts against it to kind of hedge it. Okay. The problem with options is, for cryptocurrency, it's difficult to find where to do them. Deribit is definitely the best place with the most liquidity. However, it's not regulated by US, and so they don't allow US traders to utilize it. I think unless you're accredited or an institution, that you could probably get by that. So without that, if you're not from the US, that's definitely the best place to go. And of course, it's not just the US, it's like US, Canada, UK, Singapore, and a few others are unable to use that. But if you are allowed to use that, that's the best place to go. CME is another place that you can go. The problem with there is their sizes of their contracts are fairly large. So that may be unattainable, or not really good for the sizes that you're hedging. Excuse me. There is another one, what is it called? LedgerX, which was actually on the cusp of being purchased by FTX before they went under. They provide options. However, I've never used them, and I've heard that their liquidity is pretty thin. So their mark prices are like $2,500 apart. Or at least at the time that I had people telling me about it, that's what they were. So that makes it hard to hedge if you're trying to do it in the short term. If you're doing it, for a year, then that's fine. That'll work at those big spreads. So there's that. There's also using hedging as an entry strategy, and let me just show you this really quick. I think I've gone over my hour at this point, but let's just take a quick peek at how these work. Okay, so this is a way that you can use hedging, and I've tried this, and I've had mixed results. But let's say that we have price consolidating here in like a triangle, and what we'll do is right in the center, like maybe right about here, we'll place both a long and a short position. Okay, so they're hedged. And then you set it so that once it crosses this line above here, we are going to close our short and move the stop loss for our long to the entry or break-even point, like back here in the center. And we'll do the opposite if it breaks in the other direction. So if it breaks down this way, then we'll close our long and move our short stop loss to the middle. What that does is, whether it breaks up or down, which in theory there's equal chance of either happening, the worst that we can do is break even. Right, because it's going to break in one direction. We've moved our stop loss, so if it reverses on us, at the point where it's going this way, you were losing money on this on the short, but gaining money on the long, so you were hedged. And then, if it does decide to reverse on you, you'll just be at break even here. And if it continues going up, you've dropped your hedge, and so you'll make profit in either direction. Okay, so that's the strategy. You could try it if you'd like. Like I said, I had kind of mixed results. Some things to not do, or that are not actually hedging. So in this case, this is what some people do, is you're consolidating here. They just place a conditional order above and they enter a long when momentum takes them that way, and they do the opposite to make short when momentum takes them this way. And the point here is this is not hedging, this is breakout trading. And so of course what normally happens is it goes one way, you break your, put your order in, and then it reverses, goes the other direction, and you get stopped out on that trade, possibly even triggering the trade in the other direction if you did not, think to close that one, and then it'll go back the other way, giving you that Darth Maul type of candle so that you can get wrecked on both sides. Okay, so that's that. And then the last one here is using a trade reversal. So don't do this. So let's say that right here, you're gonna, before it breaks out somewhere towards the middle, you're anticipating that it's gonna go long. So you put in a, or go up, so you put in a long. But down here at the stop loss for your long, you actually double down, and it gets created with a double the amount, so that if it does go against you, it'll stop loss out the long, but if we're going to go this way, then it will put in basically a short for the same amount. But of course what normally happens is that we go this direction and then it reverses in the other direction, so you end up again losing in both directions. Okay, this one, doing it this way, actually requires fewer changes in direction to stop you out on both sides. So don't do this. All right, so some important warnings here is, one, different exchanges have different trading isolation modes. So like I mentioned before, hedge mode on Bybit, it's something you have to turn on per instrument, and you also have to set it while you have no trades open. So you can't change that while you have a trade open. You have to think about it beforehand and make that change at that point. Also, keep in mind that when even though you might have a hedged position, that doesn't make any differences to the margin requirements and the liquidation values of either of those trades. So even though, like, if you have a perfectly hedged section and the price is going up or down, it might be showing you that your profit and loss is 0, which is what you would expect, because as you make money on one, you lose it on the other, and vice versa. But whichever direction is going in the loss direction still can get liquidated, because the unrealized gains that you have in the hedge side, or in your hedged asset, does not automatically apply to the margin available to your primary position. So as it goes away from you, people often forget about that and they'll get liquidated. The way you have to avoid that is that on the asset that you have that is actually making money, that's going in the right direction, you have to take profits on that so that the unrealized gains become realized gains. And then if you're in cross leverage mode, then you're done. Fine, that money will be available to be used as margin, and your liquidation will move further away on the other asset. However, if you're using isolated margin, then you have to manually isolated leverage, you have to manually increase the leverage, or the margin amount on that position going in the wrong direction, so that it moves your liquidation point further out. Okay, I mean, I'm assuming that you weren't at 100% to begin with, or whatever the max is allowed by the exchange. It'll allow you to kind of reduce that leverage. So again, I don't see any reason to really use hedge mode like that, because you're just creating lots of additional risks for that. So it would be better to just close out the first position and be done with it, rather than having to deal with that. I've had a lot of people I know that somehow get into a hedge position and then end up getting liquidated on both positions. Not sure how they managed to do that. But anyway, it's possible. Also, make sure you understand how the fees work. Basically, you're going to end up paying at a minimum the enter and exit fees for both of your positions. Maybe funding fees, maybe other fees for holding those positions open, for longer periods and so on. Like if you're on an exchange that, like Kraken, or something that's not an inverse perpetual, but where you actively have to pay for the margin that you're borrowing for your leverage. That can all add up very quickly. So make sure you understand all that. And I would just suggest not hedging except for like long-term positions. For that, just get out of the position if it's not going your way. All right. So to give you a summary of my approach, and this is, again, you do you. This is like how I approach risk management and how I do my trades. But I wanted to give you a summary of that. So define your trading strategy with positive expectancy using scaled risk. And we talked about what all those words mean in the first case. So backtest that strategy, verify your win rate and average RRs. And you do that at first as a backtest, but then as you actually are trading, do it more frequently to make sure that all of the assumptions are still valid. And from the backtest, make sure you're okay with that potential drawdown. So it might look good on paper, but if you're not, psychologically prepared for that drawdown, then maybe choose a different trading strategy. Okay, so use scaled entries that fail fast. That is, you want to know that you're wrong as soon as possible, and the scaled entries make it so that as you're on a losing streak, your risk goes, the amount you're risking goes down, and vice versa. As your account increases in size, you can exponentially increase that by using larger and larger risks. Okay, always define your stop loss before position size, and that's because you are going to use a dynamic position size based on where your stop loss is and what your risk percentage is. Verify that you have an acceptable risk to reward ratio too. As I mentioned earlier, maybe when you're defining your trading strategy, let's say 4-to-1 is what you think it'll average. That doesn't mean that every trade has to be 4-to-1. You can have a 3-to-1 in there as long as you have some 5-to-1s as well. But at some point you should draw the line and say, okay, this one is 1.1-to-1. I'm not taking that trade. And it might be perfectly set up with all of your other, TA that you've done. But if the risk to reward ratio, is far outside what your trading strategy dictates, then you should just take a pass on that trade. All right, so size your positions based on loss percentage. That kind of goes with the scaled entries up there. And monitor your positions and manage your stop loss as risk changes. So as you go positive or as you go negative, as more candles show themselves, then move that stop loss as appropriate to the new information that you're seeing and the new amount of capital that you are now protecting because you've gained it, but don't increase your risk, only decrease your risk in those cases. Okay, take profit at multiple levels. As someone I know always says, always pay yourself, and only use hedging for long-term positional hodl type trades. All right, and that is all that I have. Thanks for taking the time to get all the way through this. Sorry it went over an hour, and all of the assets that I showed you here, so the map itself, some of the pictures, and the spreadsheet if you want to use it, all that I'll make available as links probably wherever you have gotten to this video, and I look forward to seeing you in the next one. Thanks.